Hello everyone, welcome to QuantSap, myself Vignesh. So thanks for your valuable time, thanks for joining me in this video. So as you might have seen in the thumbnail, today's topic is about hedging. Okay, so we will be looking at various strategies that we can use to hedge our positions. So how an option buyer can hedge his position, how an option seller can hedge his position. We will look at both the strategies from a seller's perspective as well as from a buyer's perspective. Okay, so before starting the video, if you are new to QuantSap and if you haven't installed the application yet, I would request you to install the application at the earliest, okay, because as soon as you install the application, you will be getting access to 25 free tools immediately, and the link for installing the application is given in the description. You can definitely click on that link and install the application at the earliest. Apart from that, if you, as you know, like QuantSap has approximately 70 to 80 tools. Okay, so out of which 25 are free of cost. You can unlock them immediately as you install the application. Apart from that, if you want to know more about the paid tools, I have also mentioned the video libraries link in the description. So you can definitely click on that link. It will automatically redirect you to the video library page. Or else if you have installed the application, just go to learn section, go to video library. So here you can check out almost all the tools of QuantSap. Okay, so we have recorded the videos in, you can say, almost multiple languages like English, Hindi, Marathi and Tamil. So you can choose the language as per your convenience and you can explore all the videos over here. Okay, so if you have any queries, if you have any difficulties while exploring these videos, you can always feel free to contact us on the helpline number mentioned above. Okay, so let's start today's topic. So today's topic is about hedging. Okay. Okay. So how an option buyer can hedge his position, how an option seller can hedge his position. So first we'll start with an option buyer. So what all are the strategies for an option buyer? Okay, so there are, you can say, when it comes to option buying, there are you can say debit spreads, credit spreads. So first let's talk about a debit spread. What is a debit spread? Debit spread. So in debit spread, okay, there is a bull call spread and a bear put spread. Okay, when it comes to debit strategy, you can say there is a bull call spread and you can say a bear put spread. So what is a bull call spread? Usually what we do is, say for example, if you are anticipating a breakout, or say for example, if a breakout has happened and you are expecting the stock to move further, what we usually do is, we, being a retailer, we simply buy a naked call, say ATM call or OTM call, and sometimes what happens is the stock never hits the target that we anticipate. What happens is the stock sometimes stays sideways, it oscillates, and then ultimately the premium gets decayed, and we usually end up making losses, or we end, say for example, we don't make enough money. Okay, so instead of going for a plain naked call, what you can do is you can go for a bull call spread. What is a bull call spread? You can say buy ATM call and sell OTM call. Okay, buy ATM call and go and sell an OTM call. That is, we can say it is a bull call spread. So how this will help you is, say for example, a stock, this is a resistance, a stock has given a breakout, okay, and instead of moving further, this is our target, okay, instead of hitting the target, it says oscillates over here. Now you can go and buy this ATM call, okay. If it moves and closes above over here, you will have some sort of intrinsic value left. So you would have been, you could make, I can say, the profit won't be much, but still you will end up making money, correct? And at the same time, if you sell this call, this premium will get zero, correct? So ultimately this premium will get zero. So ultimately you will be making whatever premium you received will be your profit over here, and also you made a little bit of profit over here. So if you would have taken a naked call, this part is gone, you wouldn't have made any money. And here also you were anticipating the stock to hit this level, but it didn't happen. It oscillated over here. So the profit that you expected you wouldn't have made, but still you would have made a slightly lesser profit, you can say. So instead of going for a naked call, you can go for a bull call spread. Okay. Now the second one is a bear put spread. So what is bear put spread? Okay, say for example, similarly same strategy. Say this is the support level, okay, and the stock has broken this support. Okay, now your target is this one, okay, but the stock didn't hit the target. It has broken down, you can say it has broken the support. Instead of hitting the target, it oscillates between this level. Now what will happen is, again, if you simply long a naked put, okay, say for example if you have bought a naked put option, say ATM or OTM, so you wouldn't make enough money that you anticipated. Instead what you can do is buy put over ATM strike, you can say, and sell this put. Okay, so again if it oscillates here, you can say at this strike you can make theta. Okay, so the whatever the premium that you have received by selling this put will get zero and you will make the complete money over here. Okay, and also this put option you will be making slightly, if it expires in the money, you can make some sort of intrinsic value might have been left over here, or else if you have taken an OTM put, slightly lesser money. But instead of buying a naked put, if you go with this bear put spread, this will definitely help you to make money. Correct? So this is how you can hedge your positions if you are an option buyer. Sometimes what retailers do is they just go and buy an OTM strike call or OTM strike put. Okay, and the stock doesn't hit their target, it oscillates and the entire premium vanishes. Okay, so instead of going and buying an OTM put and anticipating a big moves, what you can do is you can simply go with a bull call spread or a bear put spread. That will be, you can say, a kind of hedging strategy which will definitely help you. Okay, now this was debit spread, correct? Now let us check out what is credit spreads. Give me a second. Credit spreads. So what is credit spread? Now first, before starting this credit spread, let me explain you the difference between a debit spread and a credit spread. So in debit spread, what we do is we buy ATM and we sell OTM, correct? But here in this case, we usually sell ITM and we buy ATM. Okay, when we deploy credit spread, say for example, if you are very much near to the expiry, instead of giving more premium to the market, okay, buying ATM and selling OTM is debit spread. In that case, if you see, OTM calls premiums are very less as compared to ATM. So you are buying ATM means you are giving more premium to the market, correct? So when you are near to the expiry, you don't prefer giving more premium to the market, rather you prefer collecting more premiums from the market. So what is credit spread and what all are the strategies? Now say for example, if you are bullish, instead of going with a bull call spread, we go with a bull put spread. Now if you are bearish, instead of going with a bear call spread, instead of going with a bear put spread, what we do is we go with a bear call spread. Okay, so what is a bull put spread? In case of bull call spread, what we did, we bought ATM, we sold OTM. Now here what we will be doing is we will buy ATM put and we will sell ITM put. Okay, so in this case, if you are expecting the market to stay slightly bullish or say oscillating, but if your view is bullish, then we will buy an ATM put option. Okay, because in order to hedge our positions, and what we will do is we will go and sell a deep ITM put. Okay, so when you are selling a deep in the money put option, at that point in time you will be receiving a more premium, and just in order to say for example, if the market, if the view say for example goes wrong, so in order to protect, we can say we buy ATM put and we sell ITM put. This is a bull put spread. So When to deploy a bull call spread, when to deploy a bull put spread will be a question mark now. If you are say 15 days, if more than 15 days are left for the expiry, go with a bull call spread. Say if less than 15 days are left for the expiry, if the expiry is very much closer, go with this strategy if you are bullish. Now again, if you are bearish, same what we saw there, bear put spread. Now another one is bear call spread. So what we do in bear call spread is we will buy ATM call and sell ITM call. Okay, so in this case, again, if you are far away from the expiry and if you are bearish, go with a bear put spread, that is buy ATM, sell OTM. Okay, but if you are near to the expiry, let's say less than 15 days are left for the expiry, instead of going with a bear put spread, go with a bear call spread, that is buy ATM call option to hedge, and you can go and sell a deep ITM call option. So this is from a buyer's perspective. We covered 4 strategies. Okay, now let us cover it from a, you can say, seller's perspective. So what all are the strategies, how we can hedge? That is, there are 2 strategies. Give me a second. You can say the first one I would say is butterfly, and the another one is iron condors. Iron condor. Okay, so what is a butterfly? Okay, so say for example, and when we deploy butterfly, so this is, we can say, more from a seller's perspective. Okay, say what do option sellers do? Say for example, if the volatility or has spiked up, or if they are expecting the market to stay range bound, what they do is they usually sell a range, correct? Now say in case of butterfly, what we do is sell at the money call and I will sell at the money call and at the money put. Say 1 or 2 strikes OTM, I will buy OTM call, OTM put. Now if you see, this is the butterfly. Okay, this is the body, and in order to hedge this, because I have sold ATM call and ATM put, correct? I have sold both ATM call and ATM put. If the market moves a humongous direction, say for example 1000 points upside or 1000 points downside, if any such thing happens, the loss will be, you can say, very huge. So in order to protect this, I have added a wings, you can say. Okay, this is my body. In order to protect this, I have added wings, you can say. So I will go and buy an OTM call. So if the market shoots up against this one, the call which I have sold, against this I will be making money over here. The put which I have sold, if the market drops down sharply against the put which I have sold, I will be making money over here. So this will be, you can say, a proper hedged strategies. Now what is the difference between a butterfly and a iron condor? So in butterfly we sell ATM call and ATM put, but in case of iron condor, say this is the current market price, I will buy slightly OTM call, I will buy slightly OTM put. Now again, this is more or less a strangle. In strangle, what I did, I bought this strike ATM call and put, correct? But in case of iron condor, I will buy 1 strike OTM call, 1 strike OTM put. That 1 or 2 depends, that is subjective. You can go 1 strike OTM call and put, you can go 3 strike, depends, but it should be, you can say, equidistant. In case of iron condor, usually it is equidistant. Say if you are buying 2 strike OTM call, buy 2 strike OTM put. And now again, if the market gives direction, say for example a 1500 move on either side, again you will get trapped. So in order to hedge it, say for example 2 or 3 strike OTM call, buy 2 or 3 strike below OTM put, buy. So the money that I will be, okay, my bad, sorry, this is not, you can say buy, this should be sell. Give me a second. Okay. So sell OTM call and sell OTM put. My bad. Sorry, it is not buy OTM call and one buy OTM put. If I do so, that will be a long triangle. My bad. What I did is sell ATM call and put over here. Here I will be selling one strike OTM call and one strike OTM put. That is again subjective. As I said, it can be one strike, two strike, three strikes, depends. Okay. So I will be selling a range. Okay. Say for example, I'm expecting the market to stay in this range. I will be selling this range. Okay. I'll be expecting the market to oscillate. But in case the market gives big move on either side, in order to protect, I will buy one strike OTM call or two strike OTM call and one or two strike OTM put accordingly. So I hope the strategy is very much clear to you. Okay, so this is what I wanted to explain. So instead of going with a plain vanilla flavor, a bull call spread or a bull put, plain naked call or naked put, you can go with a bull call spread, bear put spread, okay, a bull put spread. You can go with strategies. And if you are an option seller, instead of selling naked options, because when you sell options, the risk is unlimited and the profit is very much limited, correct? So in order to hedge against the unlimited risk, what you can do is, instead of going for a naked short straddle or a naked short strangle, convert it into a butterfly or an iron condor respectively. Okay, I hope you might have liked this video. This was a very basic strategies which we covered. If you want to know more about the strategy, if you want to know advanced strategies, you can definitely let us know in the comment section. We will definitely cover them as well. Okay, so I hope you liked this video. If you liked it, kindly like, share, subscribe and comment. Stay tuned. We will get back to you soon. We'll see you soon at the next video. Thank you. Thanks everyone.